Yeah, they asked me what I wanted for walkout music, and I'd never thought about that for a climate finance talk before. I'd only thought about it for baseball games and things like that. And so I I love being in Jackson. I didn't expect to be here, and we'll get into that. But as Jason alluded to, this is kind of a weird topic. It's one that often sits outside of climate finance, and climate conversations in general. And this is something I never thought I'd ever end up doing, but here we are today. So. So as Jason mentioned, so Paul Moinester, I'm the founder and executive director of Topo Finance. We are a nonprofit pioneering the field of climate-aligned treasury management, which is a very wonky way for saying essentially that we help large companies and organizations figure out how to align their banking and investing with their climate policies and objectives. So right now we're actively engaged with companies and organizations with over $600 billion in cash and investments. And we've been very blessed. We work closely with Bill McKibben. He's a big fan of our work. Ayanna mentioned some of the stats earlier. We actually have new stats that are more powerful than what she shared, but credit us with this work uncovering the largest remaining source of huge and hidden carbon emissions in our economy. So also just to note, I think this stuff's super interesting. I hope you find it interesting as well. That said, standing up here and lecturing on banking and banking stats for 56 minutes is probably not your most ideal way to spend a day. So I really want to make sure that this is interactive. We're going to try to save as much time in the end for questions. But in the meantime, if you want to treat this a little bit more like a classroom, and so if you have a question in real time about what's on the slides or if you want more information, feel free to raise your hand and or interrupt me, and we'll shout it out what your question is. And really want to make sure that we're getting through all of this information, but that you're getting the most out of this talk as possible, because this is a little bit of a weird and different subject that often does not exist in conferences like this. And so, as I alluded to earlier, if you would have told me 5 years ago that I would be pioneering the field of climate-aligned treasury management, I would have thought you were on drugs or that something really weird or bad happened in my life, because I have no background professionally, academically, in finance. I cut my teeth early in my career working on Capitol Hill. I was a senior legislative aide and did a lot of work actually around fighting big extractive mega projects. And so led the congressional opposition to the Keystone XL pipeline back in the early days, moved to Seattle in 2015, kind of parlayed that experience to fighting coal mines up in Alaska that were threatening wild fisheries. This is a picture from this beautiful wilderness in Alaska called the Chewitna watershed. That was a project they had planned, the second largest coal mining project in the US, right in this basin. And anyway, so I spent my life working on stuff like that, and that's what I thought I'd always do, until a very fortuitous and unexpected meeting that I had at Outdoor Retailer Show in January of 2020, when I got invited to meet with Bank of the West, and my colleague had set up the conversation. And I remember calling her on the way and being like, why the hell am I meeting with some bank? This makes no sense. And she was like, I don't know. They reached out and wanted to talk to you. And so in that meeting is when I sort of first learned, and I'd been in the climate space for over 15 years working and studying it, and nobody had ever told me before. I knew about divestment, but I didn't know about the central role that banks and our money plays in everyday fight of climate change, and how we can be leveraging our banking and investing as a way to drive climate progress. And it took me down a path that I never expected, including moving to Connecticut. So I 100% have the lamest answer for where are you from at this conference. It's not like Taos or Durango or something. It's outside New Haven, Connecticut. So, but I couldn't be happier to be here and be talking to you all, and thank you all so much for your interest in this subject. So, this is something that you've probably never been told before, but or never heard even, or thought about, which is that the innovation most needed to solve climate change isn't technological. It's not big, it's not sexy, it's not carbon capture sequestration, it's not electric vehicles that can beat a Ferrari off the starting line. It's actually really boring, and it's financial products and services. And that's what we're kind of here to talk about today. But if we can figure out as a society, as a community, how to harness this power, we can actually implement climate progress at unprecedented speed and scale. And so just to kind of level set, this is the gap in global investment in the energy transition. And so there's a lot of different high-level stats around this. Bloomberg, McKinsey, they all have different stats around this. But by and large, we know that in order to meet our 2050 climate goals, we need to be investing about $215 trillion between now and 2050 in order to align with net zero and to sort of stay in the bounds of where we're not all just being destroyed by climate change. And right now, as of 2023, we were looking at $1.8 trillion, as that was our investment in 2023. So there is a absolutely massive gap in where we are now and where we need to go in order to meet our global climate goals. So we spent a lot of time thinking about things like the Recovery Act, and like I worked in politics for years, and we tried to move all this big legislative stuff forward. I mean, the Recovery Act Greenhouse Gas Reduction Fund, which is incredibly important and beyond needed in this country, that's about $27 billion. That's all that it is, and it's going to catalyze a lot more investment than that, the 7-to-1 match and everything. But when you look at financial institutions, so this is everything from your Chase Bank to your BlackRock. There's over $130 trillion that's been committed to net zero alignment by 2050. The problem is that we're really far away from getting there. We'll go through some of these stats later, but this is just kind of a high-level overview. And when we think about the way that money flows through the financial system, what we really need to do is be rewiring the financial system. The way it exists right now, as Ayana mentioned earlier, it's kind of stuck in this status quo where money just flows to the people who are asking for stuff, and the folks who are asking for money are oftentimes large extractive industries like fossil fuel companies or mining projects. It's not really the clean energy solutions that we need. And so because I'm not very fun and I spend my life looking at financial statements from large corporates and others, if you actually dig in and you look at like Apple's 10K, what you actually see is a roadmap for how do we decarbonize the planet. Because everything where money flows to turns out to be a financial product and service. And those are on the books of large institutional investors to everyday individuals. And so if you think things like the housing stock, we have mortgage-backed securities. There are no green mortgage-backed securities at scale. The ability to take $1 billion through a green mortgage-backed security and flow that into decarbonization in your towns through houses that are working to install solar panels or do other types of retrofits, all of that is possible. Same with municipal bonds. There's billions of dollars in muni bonds that are being issued every year. Very, very small percentage of them are actually green bonds that are working to fund decarbonization in your town. Same goes on and on and on and again, and we'll get into all of that. But that's just sort of a high-level overview of what we're talking about here, and what we're thinking about is how do we replumb, how do we rewire the financial system that's really set up for catastrophic climate change. And we have to get in and actually figure out how do we circumvent that and rewire the whole system. And so the problem is, in large part, is that the demand has never been there. It's woefully insufficient. There's, yes, $40 trillion have committed to divestment, but when we're talking about banking and fixed income securities, so the things like mortgage-backed securities, et cetera, nobody out there is asking for this stuff at scale. And that includes the largest companies in the world like Apple, who have over $160 billion in cash and investments. And so thankfully, in part due to our work, but other things that are happening, that's starting to change, and the demand signal is starting to grow. And what I hope comes out of today is that all of you become part of that demand signal moving forward. So my talk is, cash, carbon, your climate superpower. But in honesty, it's why you should embrace your inner finance bro or broette, minus all the terrible stuff. Living now on the East Coast, I see way too many people I love Patagonia, I'm wearing a bunch of it now, but the vests and all that. And the last time I actually used this slide, there was only one person in a Patagonia black vest, and he came up to me afterwards and introduced himself, and he was a banker. So it did check out, statistically speaking, that that's the case. So before we get any further, any quick questions, thoughts? Feel free to raise hands. Great. Hopefully that means this all makes sense and not that I'm boring the shit out of you. So where did we get started? How did this all work? And so in the spring of 2021, at that time, we were in a very different place politically. We were at a very different place culturally. And big companies like Microsoft and Amazon and Google were all really doubling down on their climate commitments. They were really ramping up their net zero goals, putting more money into climate solution investments. And we just sort of asked the simple question, like, why is banking not ever mentioned in any of this? We would read through the sustainability reports of these companies, and banking and investing, there wouldn't be a word of it. Maybe the occasional reference to ESG, but that was it. And so we started asking the question, like, if Bill McKibben is telling me, Paul, where I bank matters, and I run a small nonprofit and have like $10,000 in my bank account, what does that mean for Apple, who has $160 billion, or Google that has $130 billion? And are they working on this stuff and they're not talking about it, or are they not aware of this at all? And then can we measure the emissions that stem from this? And this was sort of the hook, was could we figure out how to calculate the emissions that stem from that $160 billion and figure out how it compares to everything else they're doing as a company, their scope 1, 2, 3 emissions? And then lastly, the question was, well, where does this fit within the sort of reporting frameworks, the GHG protocol, SBTI, et cetera? How does this exist? Is this going to be outside of that, or is there a way we can package it inside that? So our motivation for asking these questions was really rooted in these three key factors, which is one, the financial sector is on this dangerous climate trajectory. At our current rate, we are going to blow way past 1.5, way past 2, because financial flows are flowing to all of the wrong places and very rarely to the right places. And we know that that system is capable of changing, but there was no pressure to actually drive that transformation. And so the idea was, like, I have $10,000 in my bank. Chase is not going to really listen to me, but they'll listen to Apple, they'll listen to Google. And so the idea was that by companies leveraging their banking investing relationships, by being able to use their social power as companies, that we would be able to actually create a demand signal to start getting the banks to move in the right direction. So just to kind of take a step back, we tend to just put money in the bank and then never think about it again. And like we're all, almost all of us, I imagine, unless you're like Jason and you've already done the right thing, guilty of this. And the story that I tell is when I moved to Seattle in 2015, I was very conscientious about doing all the right things. I got an apartment at a building that was LEED certified. I made sure I was close to transit so I didn't have to drive everywhere. I got like all of my organic sheets and my 7th generation soaps and all of that stuff for the house. And then I walked down the street and I opened a Chase bank account. And I didn't think anything about it except for like, it's convenient, it's close, and they have good rewards and perks. But what I didn't realize at the time was of all the decisions that I made, that opening the Chase bank account was by far and away the most impactful decision that I made from an emissions standpoint. And that's because when you put your money in a bank, whether you're an individual or a company, your money doesn't just sit there accruing interest. Banks take your money and they lend it out back through the economy. About 90% of all deposits get lent back out. And when that happens, it flows to everything in the economy. It flows to homeowners who are looking for a mortgage, it flows to small businesses looking for a loan, but more and more of it is flowing to the things that we don't need the money to be flowing to, which is all to carbon-intensive industries and sectors that are doubling down on fueling a climate future that is unhospitable for us. But that money can flow a different direction. And so when we look at where we are right now, we're putting this money into the account and we're locking in decades of emissions, but we have the opportunity to lock in instead decades of emissions reduction if we take action and if banks start moving in the right direction. So this is sort of a more level set on that bigger $215 trillion goal, which is that broadly speaking, by 2030, in order to keep aligned with Paris, we need $4 in green investment for every dollar in dirty investments coming from banks through their lending and investing. And where we are right now is 0.73 to 1. So we're way off pace for where we need to be. And it's fortunately starting to tick up. I think this year will be a little bit closer to 1, but we're still miles and miles away from where we need to go. And so if you take a sort of more macro view of this, what does this look like? So in the 8 years since the Paris Agreement was adopted, the world's 60 largest banks have financed more than $6.9 trillion in fossil fuel financing. Across asset managers, banks, and insurance companies, there's more than $22 trillion of exposure to the most carbon-intensive industries. And when we go back to sort of and when we talk about this with people, and oftentimes, no matter if they're a corporate treasurer or an everyday person, when we say, well, your bank's generating a lot of emissions, they kind of look at you and they're like, that's because all the data centers? And you're like, no, it's actually because of what they're doing from a lending power. So when banks take your money and lend it out in the economy, the emissions that's generating is 700 times more carbon intensive than everything else banks do combined. So all of your bank branches, your digital checking, all your paperless statements or papered statements, all of that is 1/700th of what the impact that they have from a lending perspective. So this was data that we generated last year, which is if you were to look at U.S. financial firms, so this is the 10 largest asset managers and 12 largest banks in the country, and if you looked at them and treated them like a country, the emissions that stem from their lending and investing would be the 3rd largest emitting country in the world, right behind the U.S., And so when you look at it this from the macro side, the emissions intensity of it is insanely huge. And if you look at corporate cash alone, which there's over $7 trillion in corporate cash in this country, the emissions represents about 20% of all emissions in the US. So this is a really important part of this conversation. And I think we kind of, as a climate finance community, made a little bit of a mistake when we got started because we framed this about divestment, which was how do you get your money out of fossil fuels? And a lot of that was focused purely on the equities market. So the stock market of making sure you don't own shares in Exxon or you don't own shares in other, or BP. But what we really need to be doing, and the role that banking in particular and fixed income markets play, is that they're actually taking money out of your account and putting it into the hands of the actors themselves. And so the hardest part about this is going to be stopping lending to fossil fuel companies. It's a pivotal part of all of this. But what we have to be thinking about more holistically is how do we drive investments in climate solutions, and then how do we also create a just transition in everything else. And so this isn't about just divestment. It's actually about real-world decarbonization. And so divestment was sort of 1.0 phase of the movement, and what this is sort of the 2.0 phase of everything. So getting back to these three questions that we were asking before, which were around like, are companies working on this? What are the size of the emissions and how does it fit in? The answers that we found, honestly, were incredibly startling. I'll never forget, there are these like few moments that you have in your life where you're like these big epiphany moments. And I was sitting with my partner, James Vaccaro, who works for us at Topo Finance, and he was more of a data wonk than me. And we started running the numbers on like, what does this look like? And I'll never forget asking him, we were looking at Apple at the time, and he was like, well, is it 3%? Is it 5%? And he started doing back the envelope math on it. He was like, I think it's closer to 50%. Turns out it's actually closer to about 120%. And so what we found was that for the largest companies in the world, their banking and investing is generating more emissions than everything else they're doing combined, scope 1, 2, 3. That means for Apple, every time you get on your cell phone or fire up your Apple laptop, that's part of their emissions profile. And the global use of Apple products year on year is smaller than the emissions footprint that they generate by passively managing 190, at the time when we started talking to them, $190 billion in cash and investments. And when we started meeting with companies like Apple and we would share that data point with them, they would look at us like we had three heads. And I'll never forget, we were talking to them and we said, well, do you think of your banking investment as a part of your supply chain that you need to work to decarbonize along with everything else? And they kind of nervously looked at each other around the Zoom camera, and then finally somebody piped up and said, that's an interesting question. Nobody's ever asked us that before. And it's like, well, it's time that you start thinking about it that way because your $190 billion in cash and investments is generating more emissions than everything else you're doing. And we found that pretty much with a few exceptions,
Yeah.
Yeah, so answer 3. Yeah. Yeah, so the question was, where does this fit in? And so that's what we also found, is when we went and started talking to the Greenhouse Gas Protocol, we learned that they've always thought of corporate cash and investments as part of Scope 3 Category 15. Prior to that, Category 15 was just investments, and so it would be like an equity investment. When Amazon invested in Rivian, that's part of their emissions that they have to report through that. But they've always wanted the corporate cash and investments and organizational, like foundations, anybody reporting this, to be part of Scope 3 Category 15. They just never had the data and methodology to require reporting of it. And so that was kind of the big hook now, was like, okay, well, we have this thing where we know it's in scope. And we're now actually working with the GHG protocol to get them to update this. The challenge is that in the last few years, it's become very politicized as the stakes have risen. I don't know if you all have been tracking what's happening with SBTI, but it's been just an absolute cluster. And so when we started talking to them, it was very casual, like friends talks. And now when we talk to them, everything feels very lawyered. And so we're hoping that this will come out in the new update, but we're not banking on it, unfortunately, just because of the nature of this. And so that's kind of what we found, which was like, A, this is huge. B, with the exception of companies like Patagonia, nobody's doing anything about this. And 3, that this is in scope. And so from there, we really kind of set out to do the work of like, well, what does this actually look like? How does a company like Apple, how does a company like Burton Snowboards, how does an organization like any small nonprofit actually work to align their banking and investing with their climate values? And so when we went and started meeting with companies, to be honest, most of the time, we just got very polite, like, responses of like, oh, this is interesting, like, please keep us informed, send us an email when you publish your report, and yeah, we'll stay in touch. And then they never emailed you back. The one person that we actually met who was like, this is fucking awesome, is Patrick Flynn, who was at the time the head of sustainability for Salesforce. He's now since come aboard our team and leads our corporate climate action work. And what he said is, when we met with him, he was also like totally in the dark, had never thought about this before, had built out and pioneered all of Salesforce's work across all their different supply chains, which has been copied by companies around the country. And he had no idea what this was, but he now believes that your banks and your financial partners are your most important supply chain partner for climate action and your greatest opportunity to catalyze climate progress at speed and scale. And so what we're now seeing happen is, as we grow this work, is we're getting more and more companies to start measuring this, starting to engage with their banks, starting to think about alternatives. And optimistically, we believe that by 2028, whether it's through the GHG protocol or not, this is going to become standardized as a best practice across all responsible companies and organizations, and that they will be actively working to align their financial management with their core sustainability and social objectives. And so just to kind of run through a few of the data points, this is, yep.
Sorry, can I interrupt you quickly?
Please, yeah.
Just back to that last point, and I think this is such an important key here in what the work is that you're doing. Can you just describe a little bit more about this isn't an investment movement, what the role is of CFOs and CSOs to go in and the influence that municipalities, corporations, et cetera, can have on their banking and really helping to push for them to drive the change? Because I think it's really important to go into that a little bit more.
Yeah. So as I noted at the top, a lot of the work that we do is now this advisory work, which we do for free as a nonprofit. We're happy to take people's money if they want to pay us, but we never want money to be the barrier to entry. And so when we're starting to work with companies and organizations, we're really starting at zero. In terms of like most corporate sustainability folks have no idea how their treasury function operates. The treasury function doesn't actually understand how the financial system operates within the lens of climate. And so where we really start is around this whole alignment of how do we baseline this? And so the approach that we take, as Jason noted, is not about divestment. We don't walk into Apple and say, it's time to break up your banks for two reasons, which is one, they have nowhere to go. There's no green bank in this country that can take more than like 1% of Apple's cash, essentially. And so what this really becomes about is not how do you change who you bank with, but how your bank operates. And so that really leads into the supply chain engagement that folks are doing. And so when we're talking about municipalities and we're talking about organizations, individuals, the solution set opens up because you have more flexibility. But a lot of what we're doing is really, honestly, demystifying a word that I made up called de-terrifying this, because if you walk into a corporate treasurer and you say, got to get all your money out of oil and gas, they're not going to like that. And so they're the most conservative people in the world, not necessarily politically, but their whole job is about managing risk. And so introducing new risk profiles into their work is the last thing they want. And so whether you're here from the sustainability function in your town and you want to go talk to your municipal treasury function around all this, we really emphasize and encourage the whole this is a partnership. This is not divestment. This is about just adding a climate and social lens to our financial management, just like we do with everything else that we do throughout our supply chain partnerships. Is that answering that fairly? Okay, great. Any other quick questions, thoughts? Yes?
So it looks like you're leading to the point you need to create products, financial products.
Yeah.
For green investment.
Yeah, so the question was, do we need new financial products for green investment? And the answer is yes. And so we'll get into a little bit of that as we move forward here. But just to put a little bit of data around all of this, and we published, so when we came up with this in 2021, we published the first report, was called the Carbon Bankroll. In 2022, we did an updated version of that in March of 2024, which was creatively called Carbon Bankroll 2.0. So you can find all of this information on our website at topofinance.org. But when we analyzed a broader suite of companies, and what we found when you average this out was that for these climate-leading companies, if you looked at their finance emissions and added it to what they're already reporting, their additional emissions would be about 76%. And that ranges a lot. For some companies, it's 800%. Other companies, it's about 20%. But there's a big divergence here based on how much money you have, how you manage your money in terms of what financial products and services you need. Things like mortgage-backed securities are less climate intensive than a dollar in a bank account, but it's also about how carbon intensive your business is. And so if you're Amazon, your carbon footprint is going to be much higher than, Atlassian or somebody like that, which is a software company. So, and the reason why this is happening and what companies and all of us unknowingly are letting happen is because when we go and put money in a bank, a big Wall Street bank on average, about 20 to 30% of the money that they lend out is going to go to the world's most carbon intensive sectors like energy production, utilities, mining, and large scale manufacturing. And so that's the bulk of the emissions that come from this, is that lending to these incredibly intensive industries. And so if you're, one of these large companies and you've got, 130 people on your sustainability team and you're spending hundreds of millions of dollars a year decarbonizing all of these things, but then meanwhile, you're not paying any attention to what's happening with your money, and then you have billions of dollars a year being lent directly to the carbon intensive industries that are not only generating a ton of emissions, but also making it harder and harder for you to achieve your climate goals. Because right now, 20% of your money is likely flowing into shit that you don't want it to flow into. And so what if you went to your bank and you said, make as much of our money as possible flow into the things that are going to help us meet our climate goals and objectives? And so this is Jason's, I think, favorite stat, in part because he drives a Tesla. But so what's happening is this is actually undermining a lot of companies' climate work. And so if you look at a company like Tesla, regardless of what you think of Elon Musk, from a climate solution standpoint, they're building electric vehicles that are helping us avoid a lot of emissions. And so in 2023, and these are all, we don't have, I should note, we don't have any actual direct insight for a Tesla in terms of where they're banking and how they're managing their money. So these are all indicative kind of analyses that we do based on the data that we have and what they publicly report. But in 2023, Tesla sold over 1.8 million Teslas, and they don't actually do emissions calculations across their fleet, but based on what we could gather from that, we basically figured out that generates, that's about reducing about 6 million metric tons per year. But their banking and investing, which they're likely not paying any attention to, is actually generating 6.3 million metric tons of emissions per year. And if you look across the EV sector, my favorite one to pick on is Rivian, who has producing 25, 50,000 cars a year, but whose banking emissions are, $1 billion is basically the equivalent of about 120,000 cars. Last I looked, Rivian had over $10 billion in cash and was making under 100,000 cars. So even for the most well-intentioned companies out there, if we don't get our arms wrapped around what this means, we are just kind of continuing to undermine the impact that we're trying to have by this passive financial management. Do you want to say anything else about that?
No.
Okay, you're good. All right. This is Jason's favorite, so I wanted to give him the chance. And so Jason and I worked to then take this all down to the individual action level. And we did a report with Project Drawdown last year, and we've now since updated that with new data that we have. But if you look at individual actions, things that we think of all the time as being these things that we hold, frankly, so much guilt around as consumers, flying, the flight from, the average American's annual flying footprint is about 0.6 metric tons per year. Their diet's 2.3 tons. Your energy is going to be 2.8. But just $10,000 in a big Wall Street bank is going to be about 2.9 metric tons of emissions per year. And the more money you have, the quicker all of this stacks up. And so if you look at it from an emissions reduction standpoint, and I need to note the caveat that all of these things in banking are all averages, they're all indicative, we need to be doing all of these things. This is just used entirely to highlight how big of an issue that this is that if you adopted a vegan diet, you'd be reducing your emissions by about 0.9 metric tons. But if you just move $10,000 from a green bank, from a Wall Street bank to a green bank like an amalgamated bank or a climate first bank, you would actually be generating about 3 times the emissions reduction of that. And so even the simple act of, I think the stat off the top of my head is about $13,000, which won't cost you anything except for maybe a little bit of a headache, to move that into a greener bank, the indicative emissions reduction of that is actually larger than switching to an electric vehicle. And so we worked with Jason and his team at Compose Creative to actually build this tool where you bank matters. If you click on this, or excuse me, if you use this QR code, you can access this tool. But it allows you to go in and just say, I have this much money in this bank, I have this much money in this bank. If I moved it from, Wall Street Bank to Green Bank, this is what the emissions reduction would be, and this is how it compares to things like how many miles driven, flights taken, et cetera. And so,
Sorry, if I can just jump in here
please,
as well too.
yeah.
I think this is, I know that we just said from a corporate standpoint, this isn't a divestment movement. From an individual level, it probably is more of a divestment movement. Everybody just did Dr. Johnson's Venn diagram, and so this is the way that really culminated for us. We're taking, what I love, which is being creative, the work that needs to be done, raising awareness around this, and then what are we good at? I have an amazing team behind me that does a lot of fantastic work. So that is really all came together to drive this tool in and of itself, is to really raise awareness of this. And I would the reason that I'm so passionate about this and to really highlight it is that as individuals, you see what we can do is really limited compared to what corporations, municipalities, et cetera, can do, right, as far as moving the needle. I would argue that this is the number 2 single largest action that you can take as an individual behind voting in really driving systemic change. So I think it's just a really huge thing to call out, make a key point of, and would encourage everyone to shoot the code, take a look, because it's pretty fascinating data, and then we put that into real world terms as far as, so, if I just tell you can reduce it by like 3 metric tons of carbon, everybody kind of gets it, but it kind of goes over your head. But then we break that down into what does that mean as far as like miles driven in a combustion engine car, 6-hour flights taken, pounds of beef eaten, et cetera. So please take a look and check it out.
Yeah, and appreciate that. And the number that Ayana used in her talk was based on our data. It was actually old data when she said that basically you're looking at $125,000 equals the average American's carbon footprint. Our new data shows that it's much closer to like $55,000, and that's just what you're doing from the average American's carbon footprint. And so when you start then factoring in what you're doing from an emissions reduction standpoint, it gets much, much higher. So yeah, you had a question. Yeah, I can send anybody any of this information. Yeah. Yes, yeah, that's what we're getting to. Yeah. Sorry, just to make sure I understand, like financial firm evaluation? Yeah, so it's a really good question, and unfortunately, since we started this work, financial firms have, broadly speaking, taken a step back. Most because of the anti-ESG movement. A lot of these big banks are starting to and big asset managers are starting to walk back a lot of their climate commitments and start sort of really kind of moving away from some of this stuff. But this, once again, speaks to the power of this from a corporate side. And so don't quote me on these numbers, but I believe the last I looked that divestment has cost BlackRock across all of these states. And so, sorry, not divestment, but when the anti-ESG folks are blacklisting banks and asset managers like BlackRock, it's cost those banks and asset managers, I believe, about $4.5 billion, which is not in business, which is not insignificant until you think about the fact that Microsoft alone has more than $10 billion in their pension plan with BlackRock. And that the companies that we're working with and identifying have over $600 billion in cash and investments. And so we haven't gotten to the point yet where this is being mobilized yet to the level where banks are starting to really respond to this. And the question was around, is it really reducing their sort of value and their place in society? And it hasn't started happening yet, but I think we're every day inching closer and closer to that. Yeah, question? Yeah. Yeah. Yeah, so the question was around where do credit cards fit into all of this? And so credit cards, and this is part of what we're really sort of preaching, so credit cards don't have the direct carbon footprint that banking does because it's a service as more than it is like your money being directly lent out. But it's a huge revenue generator for these banks. And so a lot of what we do with companies and organizations is we're sort of pioneering this new kind of split and shift approach of how do you unbundle all of your banking services? And so what are things that are fungible and what are things that are not? And so if you're Apple, you're gonna need to bank with one of the big banks in this country and banks globally. They can move some of their money to an amalgamated bank and others, but we're just talking a little bit. But what they can do is take things that are more fungible, like money market funds or other banking products and services, and work to align those and to use those as a lever in the meantime to start using that from better banks. So like there's a great French bank called BNP Paribas, which is one of the leaders as far as like these big global systemic banks. And so it's like, well, instead of buying it from Wells, do you maybe go and buy it from BNP instead? Or can you buy some of this stuff from greener banks or smaller regional banks in the US? And so, from where that translates to on an individual level is like, if you've got a Bank of America credit card, but you don't have an account with Bank of America, it's still like you're not going to have the emissions generation around it all, but you're still giving Bank of America and sort of rewarding their business model. And so the question is, can you find other more green financial products and services? And when you do that switch, go tell Bank of America that you're leaving them because of their very misaligned climate policies and practices. And when you join the new one, let them know that you're rewarding them for this so that they then continue to invest and get better and better and better.
Paul, we had one more question over here.
Yeah. Yeah, it's a great question, which is around how, as a consumer, are you thinking about this in terms of where the sort of benefits are, what you're willing to leave, what you're willing to take. And just to kind of use some of these terms, and so ESG, which is the term that sort of has become kind of the status quo around this, which stands for environmental, social, and governance, it's actually more about risk than it is about impact. So it's about risk mitigation on behalf of your investments. And so making sure that your dollars are not going to be risked by environmental damage. Or look at a company like Tesla. They have a lot of governance issues. That's part of the reason why they got taken out of ESG accounts, was because it's a governance nightmare. And that is going, from an investor standpoint, you want to account for all of that. Where we tend to focus is much more on the like direct carbon side of all of this, from like what is the emission side of it. And so that becomes a little bit of a trickier part, and that's why we built things like this tool, but it's a lot of the work that we're doing, and it's why we do this advising and consulting work. And so happy to do it with any organizations. If people have questions about their individual portfolios, I should also note, very much an important disclaimer here, we are not financial advisors. We are not a financial firm. We are climate advisors around finance. And so none of this is finance advice. And so whether you're incorporating this in your town, for your business, or for yourself personally, just that important disclaimer, which I definitely should have put on this slide. So my lawyers will not be happy about that. But yeah.
How are you ranking those big multinational banks? How do you know BNP is better than?
Yeah. It's a great question. So the question was, how are we ranking and evaluating banks? It was actually when I told you about that project, that conversation I had in 2020, that was actually the initial idea was, could we build a certification system? Could we build some type of rating evaluation system? Because every great environmental transformation that's been led by consumers has one thing in common. They have good choice architecture. It means that like when you go onto a car lot back in the day, you would know how what the fuel economy was of your car, because you would see the ones at 30 and ones at 12. When you go to the grocery store and you go buy bananas, you know which one's organic, you know which one's not. When it comes to banks, like even folks like us don't really have a great rating system yet for like what is good and what is bad. And so we use a very simple metric right now, which is just carbon emissions. And so that's what all of this data is about, is like what is the average emissions, and that's based on an emissions intensity, which is for a specific year, just a snapshot in time, how much of your money, when they are lending their money out, what is the emissions intensity of that? But what we're moving towards, and a lot of the work that we do with companies, is helping them do a more quantitative and qualitative assessment. So then it starts getting into their policies. And a lot of that's up to you as a consumer. And so if you care a lot about deforestation, you might have different feelings on some of these banks based on how good their policies are around deforestation. And so we haven't developed yet a universal sort of catch-all metric or a rating system for this. We're moving towards that, but it really becomes a more holistic view of like, where are they now? Where have they come from? Because trajectory is super important, and most importantly, where are they going? And so there might be some banks that are actually doing a lot now, but their numbers are still higher, but you're not going to want to switch your bank every year. One of the craziest stats that we found around individuals is that the average American, when you buy a car, you have it for about 8.5 years. When you buy a home, you have it for about 13 years. But when you open a bank account, you have it on average for 17 years. So this stuff is super sticky. And so playing the long-term game of like, where's the trajectory around all of this is critically important, because I can guarantee you if I said move your money out of bank A into bank B because their numbers are a little bit better now, but then in 2 years, bank A is much better, and you're like going to look at me and roll your eyes and be like, cool, now I have to like undo all of this work that I've done. And so it's part of what we're moving towards, but it's part of the complexity around this, in part because there's been no demand signal from companies. I mean, literally none of the companies that I've referenced, with the exception of Patagonia, had we ever, and Netflix actually, I should say Netflix, had ever met with their banks about their climate policies and practices before we started talking to them about this stuff. And so no wonder they have terrible reporting and little transparency around it. It's because no consumers have ever asked for it before. And so with increased asking, we're going to get increased transparency. But also as a community, we'll sort of center around a little bit more standards around what constitutes good, what constitutes better, and sort of what constitutes like definitely try not to work with them if you can.
Actually, sorry, I just want to be cognizant of time. There's a bunch of municipal leaders in here. I know
Yeah.
there's some great stuff around that, so if we can just get through
Yeah.
this, and then we'll get back to your questions. Yankees hat, I see you.
All right, sorry, yeah, so to skip to the municipal part of all of this, this was not to pick on Aspen. We just happened to have good data around it and chose them, so. Yeah, no. But when we looked at Aspen, and this was a study that we did before the Mountain Towns Conference last year, basically what it looks like is about the emissions uplift. I mean, how much their banking and investing is generating from an emission standpoint compared to their other reported emissions is about 27%. So this isn't as big as it is for Apple, but it's still a huge, sizable chunk of emissions. And so we are actually working with Mountain Towns 2030, and we are launching a new pilot project. We already have a few communities that have expressed interest in this and that we've been talking to. And what we're going to do is form a working group, and we are going to work together to, and this will be all supported for free by Topo, is come in and help you create internal alignment between your sustainability and treasury teams around what does this look like, how you should be thinking about it. We will help you measure your financed emissions if that's something that you want. And then we'll work with you to develop a roadmap for what does decarbonizing your finances look like based on your unique situation, what your service needs are, what your liquidity needs are, what does it look like in terms of how can we split and shift your banking to get it as aligned as you would like, or how can we help you engage with your banks to be able to get and hopefully push your banks to be better and better on this. And then from there, and this is sort of the biggest part of this, and this gets back to your question about the sort of financial products and financing vehicles for this, is start exploring the innovative financial part of all of this. And so we're in very early stage of all of this, but if you start thinking about what you as a city or what you as a company have on your balance books in terms of the financial assets, we really have this incredible idea or opportunity to rethink how we are building and scaling new financial products. And mountain towns are in an incredibly exciting position to be able to actually not just think of your banking as this other part, but to actually think about how can we now use this growing demand for green financial products to actually decarbonize our own towns. And so from talking with a lot of leaders in the past around all this, no matter how much wealth you have in a town like Aspen or Jackson, like you still have huge budgetary restraints in terms of like how are we going to finance all of this stuff? What are we going to do as a town? We don't want to raise taxes because nobody loves having their taxes raised, especially in high net wealth in communities. And you know, there's not a lot of money from government when there's all these other needs and services. And so how can we think about creating novel, innovative financial products and services? And so one of the ones that we've been thinking about, and I should note, sorry, to go back one quick thing, which is like we are still very much trying to build this coalition. And so if you all want to be a part of the Mountain Towns and Resorts, email me, paul@topofinance.org, email Chris Steinkamp at Mountain Towns, who's helping us pull together, or just come grab me today and say, like, we're all in on this. Yeah, question. Yeah, it's a great question. So the question is, like, what's the approach? Is this like a move your money or a stay in? And the answer is, like, it's whatever works for your town is kind of the answer. Like, we are not, we are very pragmatic in how we approach all of this. And you know, if you're, like, I believe Boulder, for example, has done some work moving their money out of big banks into sort of more regional banks. And so like that's something to do. And so whatever is comfortable, like if you have a banking partner that you love working with, then maybe it is an engagement strategy, and maybe you're just breaking off some ancillary services. If you, like we talk to a lot of companies that don't love their bank because like banks aren't exactly the most like lovable fuzzy creatures in the world, and they want to leave, then we can help them identify new ways for doing that. And so like, for example, we're working right now with a company to actually develop, it's our first version of like a green RFP. So they're looking for a new banking partner just in part because they hate their bank from their services and just like all of that side, yet alone the climate side of it all. And they were already itching to leave. And so now we're sort of building the questions in of like, okay, great. If you're looking to issue a municipal bond as a city and you need a banking partner for that, you can vet banks based on their environmental performance, and you can try to choose the most aligned version of that. Is that impacting your carbon footprint? No, but it is rewarding better banks and giving them more liquidity to start lending and reducing the liquidity of big banks. And so for this pilot project, it's a total blank slate of when we will work with you to figure out what is best for your community, what your treasury team wants to do, and where you can have the most impact. And our belief in all of this is like there's no right answers. Charlie Bischoff, who's the treasurer of Patagonia, who's become a good friend of ours and we work with really closely, often jokes, especially when it comes to like working with big banks, it's like you're never getting who you want. You're always trying to choose like the least bad option, which is a little bit of a dire frame to explain all of this. But there might be some opportunities to actually have some great options depending on what your banking needs and services are. Yeah, quick question. Yeah, so that's a great question, and it's one, honestly, that I don't know the answer to yet, and that's part of why this is going to be a little bit of joint learning. We've never worked with communities around this, and so the question was about any regulatory things in place. If you're in a state where there's a lot of anti-ESG, I mean, that's part of this too, which is the nice thing about banking is like you can talk about it if you want to, but it is also totally private most of the time, so you don't have to talk about a lot of this stuff. Some municipalities do share that, and that might be statutory. I don't know what the disclosure is around all of that, but part of what we're going to be doing is kind of digging in and understanding the landscape for how you can both meet your fiduciary responsibilities, meet any regulatory requirements, but also align your banking and investing with your climate objectives. So, yeah.
Would this include employee pension and retirement programs as well that are offered by municipalities?
We were going to focus more primarily on the sort of like the day-to-day treasury management, but if you want to involve your pension side of stuff, we can definitely help with that as well. Yeah, question in the back.
Yeah, I have an observation and a question.
Yeah.
And a request.
Yes.
Observation is I went to your presentation last year.
Yes, I remember.
There were about 10 people.
Yeah. Yeah, so thank you all for being here. This was a much more full crowd. Really appreciate it. And also thank you to Mountain Towns for giving us a bigger forum to talk about all this stuff. Yeah. Yeah, no, I appreciate it. And it's a great point that I forgot to mention, so thank you. You brought up great points last year, I remember, and I appreciate you bringing them up again, which is our hope coming out of this project, when we think about it from a more macro lens of where does this sit within this community, is one, we'll hopefully design a playbook, essentially, where we can share what has been done by these communities. They may be named, they may not be, but just in terms of like what are the strategies, what came from it, and what you can do. And the hope next year is that I'm not up here alone talking about this as like this is what you should be doing, but we'll have a number of mountain towns who we can have a whole panel conversation around what they did, what they accomplished, and where they're moving next, and why everybody needs to be following in their footsteps. So that's the desired outcome. Yeah. Yeah, so that's a great question, which is like, what does this do for you financially? Are you giving up money, potentially leaving money on the table? And the answer is like, it depends a lot on what you're talking about. And so, if I would have known that you would ask this question, I would have had this slide in here. But Charlie Bischoff, who's the treasurer of Patagonia, says that they actually are generating more money through their financial services now, financial management services, because it forced them to be more innovative and go out and look for better options. And so for sure, you can lose money if you don't do this the right way. But what we have found, and actually we're developing, and so the question sorry, was Jonathan, is that right? Yeah. Yes. Asked earlier, which is like, what is some of the progress? We're actually starting to really dig in on the product side of this, and part of the reason I actually moved to Connecticut is because I have a business partner there, and we're starting to build new financial products and services and moving out of just the like thinking about it and talking about it. One of those is a great product. There's a company called Max My Interest. They essentially developed a cash sweep. This was not intended to be a green product at all. It was purely intended to be just like, how to help rich people make more money off their money, but also how they can also reduce their risk. And so what happens is they have there's things like this, Wealthfront, Intrify, et cetera. They have patents and a whole different way of doing this, which is they can take your money. So let's just say you have $1 million in a bank, only 250,000 of that is FDIC insured. You can then break that up through Max and put it in 4 regional banks instead and maximize your interest rate. So right now they're actually getting 5.4 for an interest rate, which is way, way, way above market rate because they go and privately negotiate with banks that need that extra liquidity. And so the funny thing is that Gary, who developed Max, literally had no idea that this was a climate product until we started talking to him. And we're going to be working with him to do this analysis, but my hunch based on what we know is that Gary is, when you move money through Max, you're actually not only maximizing your interest rate, but you're also reducing your finance emissions by about half. And so our hope over the coming years is to start bringing on banks like Amalgamated and Green Banks and actually make this a cash management solution for towns. He's building out a whole commercial product that we're working with him on. And it is kind of this unicorn that like you actually make more money, reduce your impact, and have the same day liquidity and have all the service needs. And you still maintain your relationship with your existing bank, your Chase, Wells, et cetera. And so real quickly, just to say that like when we've done this macro analysis for Gary, this is all very back of the envelope. Like this is the power of climate finance, is that I could make a very data-driven argument that Gary unintentionally built a climate fintech company that is responsible for more avoided emissions than the entire EV industry in the United States combined, and he had no idea he was doing it. Like that's the power of finance, and that's why we need to be investing in all of this stuff. Jason.
I would just add anecdotally, when we moved our money and really looked at it focusing on greener banks, we saw a pretty significant rate of return, especially when it came to interest rates that were being offered. That said, I'm also being told that we need to wrap it up. I don't want to forget my friend in the Yankees hat, especially since we won 1-0 last night. So we'll take one more question, and then if anybody else has any other questions, please come up to Paul afterwards.
Yeah, I mean, I think that what we're going to see is a radical transformation if we're successful in how the financial system operates. And that's going to happen in a lot of different directions. So one of those is, and this is, we went and met, partners of ours went and met with First Republic, which was a large regional bank that went out of business because they had terrible financial management. But when we went and talked to them, we said, look, there's all this potential demand here, all of these companies that will want this. Like, can you be greener? They were already pretty green for a regional bank. That was based just on their business model. And they said, show us the demand exists, show us that companies will actually move to us, and then we'll be greener. And so much of what we're doing now is for the first time, there's companies with hundreds of billions of dollars that are going and talking to their banks and demanding that. And that chorus, especially with all of your help and support, is only going to grow. And so the hope is to make banks warmer and fuzzier than they are, and to make this something where not only do we have banks that are not lending 20% of their money to fossil fuels and other things, and instead are investing in climate solutions, but where there's also something like this. So I know we need to run. This is my last quick thing, which is this doesn't exist to our knowledge now. But if us as a mountain town community, if we all came together, we could figure out how could we do a collateralized municipal bond. So if you took all of the things in your town that need to be financed, that need to be retrofitted, especially ones that are revenue generating, because this makes things easier. So things like putting in EV chargers, we could work across all of these different mountain towns and come up with one collateralized green financial product. So it might just be $10 million in Taos, but maybe it's $20 million in Aspen, and then you pull that all together, and now we can go out to a bank and go get $500 million to then do that, and we can rate and score that and then turn around and say, hey, Microsoft, you have crappy muni bonds. How do you feel about this green muni bond that's going to be decarbonizing all of these mountain towns? So that's where we're going to be moving towards. And so I know we need to run, but I just wanted to close with that to say that, and to answer your question, which is like, this is going to happen in both directions, both from the demand side of it, from customers asking, banks then doing that, but then banks are going to have to figure out how to start doing stuff like this because there's not a shortage of projects. There's not a shortage of money. There's a shortage of imagination and demand. And so banks will tell me all the time we're doing the best that they can, and I honestly just like call bullshit on that because they are not treating this as the arms race. They are not doing the innovative thing. They make big commitments around emissions reporting and emissions reduction, but they're not thinking day in and day out, how do we leverage the dollars that we have under management to drive decarbonization and make money doing it. It's all possible, but we've never asked before, we've never demanded it before. And so that's what we're all about. Can't thank you enough for your time and energy. If you want to email me, you can reach me at Paul@Topo Finance or find our work at topofinance.org. And hope to work with you all over the next year on all of this, and hope to be back next year with a bunch of other mountain towns and be on stage and talk about all the great work we've accomplished. So thank you so much for your attention.
And just to that point, lunch is happening now, and breakout sessions begin at 1:15. Thank you, everybody.